Every event that occurs has unintended or unforeseen consequences that then, in our field, particularly affect the stock market. Take the pandemic as an example. Unintended consequence was everybody had to stay home, so some companies profited and some companies failed. Peloton blew up. Zoom had a surge. And then on the other hand, the oil companies fell apart. The airline companies fell apart. The cruise lines fell apart. And so some people made money while other people lost money. So the key is to look at the event that is happening, that is unfolding, and anticipate how it is going to affect the stock market, either positive or negative, and then put yourself in a position either where you don't get hurt by it or you make money on it. So what is the event? Well, the event is the increased interest rates. I showed you this chart not long ago that showed that the interest rates had dropped down where corporate debt and investment grade debt had gotten as low as 3-4%. But as Jerome has been raising interest rate, that corporate debt is being refinanced at higher rates, up around 9 or 10%. Well, when is this going to mature? I showed you this chart that in the remainder of 2023, annualized, it's going to be somewhere in the neighborhood of $600 billion. And that will get up to over $1 trillion of maturing debt by 2025. Well, if your cost of servicing your debt goes from 4% to 10%, a 2.5% or 2.5 times increase, what is that going to do to your earnings? What's that going to do to your bottom line? And I showed you this chart that I went through and did an analysis of my bus 13 and bus 14 to give me an idea of how much debt do each of these 30 companies have, and what is the effect of that cost of that increased cost of debt going to do for their projected earnings in the future. And the stock price is merely a multiple of projected earnings. So if their cost of debt goes up such that it brings their earnings down, well, their price is going to go down, okay? So I have been maneuvering my portfolio and getting out of those stocks that are going to have a negative earnings as a result of the increased cost of debt. So I got to wondering, okay, I'm positioning myself in the bus in 12 and 13. What is the effect of this going to be on the S&P? Well, I took the same data. I have a source that I go to for the data of the balance sheets and the income statements for all of my bus 12 and bus 13, and I share that with my subscribers on my website. So then I said, let's just upload all 500 stocks in the S&P 500 and calculate what is their earnings of 2022 at a 4% interest rate on their debt, and then what are they on a 10% interest rate on their debt, and how is that going to affect the overall S&P 500? And that's how I came up with expect the S&P 500 over the next 2 years to drop 35%. Now, I don't know that this is accurate, and I don't know that it's something I want to put in stone, but it is something I want to put in front of you. And I want to get your feedback on the numbers that I share with you. Is this realistic? Is this the right way to evaluate what the S&P 500 and the stock market as a whole is going to do as a result of increasing interest rates? And those interest rates are those loans, roughly $1 trillion worth of money, the cost of that money going from roughly 4% to 10%. What's the cost? How's that going to affect my portfolio? What do I do as a result? This is not financial advice. This is me sharing my research so that you can give me feedback and say, did I do something wrong here? Or am I right on? And how can we work together to make this, or to help us make better investment decisions as we move forward? Okay, I got to do this disclaimer, and then I'll get into the numbers.
Best of Us Investors presents Kerry Griegmeyer.
Okay, this is my Excel spreadsheet that I've put together, and then I've scraped the internet for all the data on the S&P 500. Actually, I can access the data from the balance sheets, from the income statements, their key metrics, their financial growth. I can access all of that for over 6,000 companies. But then what I did was build this spreadsheet that gives you their ticker, their name, their current price, their revenues for 2023, their income for 2023, their current debt, that's how much money they owe, their interest. And what this is an actual number in their balance sheet of their interest expense. Actually, it's from their income statement. Then I say, okay, if that interest increases, or I'm using 10% here, how much will that interest go up? Let me show you some companies that you'll recognize. As I said, this is all the whole S&P 500. And I've highlighted some of them here in red. Here's Ford Motor Company. Revenues of 2023 of 169 billion. Income of 4 billion. Current debt $144.8 billion. Again, this is off of their income statements and their balance sheets. Their actual interest expense, which that shows on their income statement, is 2.7 billion. We figure that at about 3.8%. Well, if that goes up 2.5 times, that turns into an interest cost of $14 billion. What does that do to their projected income? Well, their income, if you'll remember, was 4.3. Their interest is now 14.4. So they now have a loss just as a result of their interest expense of 7.7 billion, or a negative 152% on their earnings. Yes, on their income. Some other names you might. Here's IBM, International Business Machines. Their revenue of 60 billion, their income of 2 billion, their current debt of 60 billion, and we end up going from a income of 2.0 billion to a negative 2.6 billion. That's what's going to happen. Now, can they stop it some way? Well, they do have free cash flow of 10 billion. So theoretically, they could pay all that. No, they can't pay all the debt off. They can pay 1/6 of the debt off. They may have to do that. But then what do they do for research and development as we're moving into AI? You can see this all the way across the board. Here's Walt Disney. Here's their revenue now. Here's their income now. This is their interest expense at 4%. This is at 10%. We're going to see a negative. Okay? You pick the number or pick the company. They're all there. But let me take you down to the bottom, because what I'm really interested in is what kind of effect is this going to have on the S&P 500. And here we find the bottom. And who's sitting on the bottom? Well, United Airlines. We all know them. They have revenue in 23 of 50 billion. They have income of 2.6 billion. They have a debt of 35.8 billion. They are paying interest currently of 1.7 billion on that. That's going to go to 3.58 billion. So their income, projected income, will be $855 million, where it used to be 2.6 billion. Okay? These are the numbers for all 500 of them, okay? Revenues of 16 trillion, income of 1.6 trillion, current debt of 9.7 trillion, interest expense for the whole S&P 500 as of 4%, $553 billion, which is going to go up to 966 billion. That's the cost of their debt, or an increase of roughly 75%. Then we go to their income. Their total income projected after they pay the increased price on their debt is $846 billion as opposed to $1.68 trillion. That's a 50% decrease. Okay, so then I say, all right, let's take the change and just take an average. And some of these, showed up negative. The average change will be down 35%. And that's how I came up with a 35% number. But wait, maybe it's not that. Maybe it's this number. Maybe the projected income loss, 50%, is the real loss in the S&P 500. Could that be? I don't know. I just crunch the numbers. I just use my artificial intelligence that gives me access to all this data, and then I analyze it. I want you to analyze it. I want you to replay all this and tell me, am I missing something? Or are these companies up for some real disasters? Now, that's just as an increased cost of servicing their debt. What about the increased cost of their fuel? United Airlines. What is that going to do to their earnings? What is that going to do to Amazon, who has all these trucks running around delivering everything in the next day? What is that going to do? What is it going to do to the fact that consumer debt is going up, and the fact that they aren't going to be able to spend as much money at Amazon or at United Airlines or Delta Airlines or Boston Scientific? You pick the name. What is the unintended consequences of interest rates going literally from 0 to 10%? Can we just forget about it and say none? I don't think you can forget about that any more than you can forget about the unintended consequences of the coronavirus, of the 2009 subprime crisis, of the 2000 dot-com bubble. This is here. It's a part of our lives, and we best get ready for it. I don't think the rest of the world has recognized this, but you and I now know about it. We know what is happening. We can project because we can now scrub the internet and get all their numbers. There's no secrets here anymore. What is going to happen? And then most importantly, what should I do about it? Should I go to cash? That's kind of what I'm doing. But I'm only focusing on my Bus 12 and Bus 13, and those are the stocks that are going to benefit from artificial intelligence. But before they can benefit from it and come out on the other side, they got to deal with this. I mean, Microsoft is not going to increase their revenues to disproportion the amount of debt they're going to have. Amazon is not going to increase their revenues to overcome the debt that they've built to build all those distribution centers in your city and the gas they're going to spend. They can't get past that. Even if they improve our lives with artificial intelligence and make our shopping on Amazon better, they can't get past this until those interest rates come down, or we just absorb it. We, the consumer, absorb this 50% loss in income that the S&P 500. And if you really want a bigger nightmare, go look at the U.S. debt. Back in 2000, it was $4 trillion. It's now going on $34 trillion. You got to understand the unintended consequences of debt. Okay, I'm Kerry Grinkmeyer. I'm a crazy retired financial advisor who is taking advantage of what the internet presents me, that I can go and grab the balance sheets, the income statements, the key metrics, the financial growth of over 6,000 companies and have it on my computer here in my office and analyze it. And then share it with you. If this is the kind of stuff you want to have access to, if this is how you want to learn to make better investment decisions, then come join our tribe. And how do you do that? You go to the website down there, Best of Us Investors. You find this box and you click that little box that says, Kerry, that's worth $60 a month to me to make better investment decisions. And Kerry, if you'll share that with me, if you'll share your hard work with me, I'll share my $60 a month with you. Okay? Get on the bus.